Your house is worth whatever it's worth, right? Whoever sells it. Wrong. I'm Charlie. Welcome to Moving Home with Charlie, and thank you for coming.
Charlie Landing grew up in Sussex, is the founder of Best Agent and presenter of Moving Home with Charlie.
If you want to find one of these guys, look out for those compassionate professionals. All estate agents are not the same.
So Charlie, what would be your advice for people interested in buying new builds right now?
Don't overpay. Do buy, but don't overpay. That's why I say disregard the guff. Read into the numbers and look, and it's buried. The bad news is buried in the small print, okay?
Good evening, everyone. Welcome to the Property Press Awards.
They may or may not be telling the truth, but you should form your own view. Get out and view, get out and view, get out and view. You cannot be in a position to make offers and have no offers accepted if you're not viewing. So be out there viewing. Pay attention to the back of the class if you've not been watching my videos. I did one just a couple of days ago. Disregard the guff, guys. Good evening, everybody. Welcome to the late night live stream. I haven't done one of these for a very long time, but let's see how it goes. There's just stuff I wanted to say about the housing market right now. So much is happening so fast, it's frankly almost impossible to keep up with it. And tonight I have got waiting in the wings already, Housing Stig, and also last minute guest also joining is Lewis Shaw, one of the mortgage brokers that I work with, who texted me to say he was around this evening if he wanted to join in. So hopefully he'll be, he said he's firing up his laptop now, which makes it sound like he's cranking a handle and waiting for the engine to catch. How is everyone tonight? Who've we got here? Ricky Heath, fresh name, welcome. Richard Baker, Visual Ghoul, Jack Waldron. Well, it's quite a good turnout considering the short notice and the late time. Hello, Amir, Martha, Cruffy Pay. Right. I think most of you probably follow me on Twitter. But I'm going to get straight into what I wanted to say this evening. As you know, my message has always been that it doesn't matter whether house prices are going up or going down. If you've got the money and you can afford to buy now and you found a house that you want to live in for the foreseeable future, buy now and just don't overpay, because having a home that you own and living in it for non-financial reasons, in other words, because you want to live in that home and you want the security of a home that's yours and you don't want to be renting, is worth more than just saving some money by waiting to time the market. I've always said that. And whether or not you're overpaying is always a personal choice, a personal calculation, and is unique to each individual buyer based on your unique set of circumstances. But it's been a long time since, it's actually almost exactly a year since I first actually called house prices are going to fall, and they were starting to fall at the coalface almost a year ago. It was May the 19th last year when I put out a video on my Best Agent YouTube channel for agents saying, this is it, there's no doubt house prices are coming down. And at the coalface they were, and it started to get reported in August, about 3 months later, which was when Nationwide first said, oh, month on month house prices started to come down, which timed right with my May talking about house price falls. But what's happened is, because, I mean, it's been 9 months since that video I put out saying 8 reasons how UK house prices will collapse. And so far, the reported prices haven't shown signs of collapsing. They've shown signs of falling, but not collapsing. And then we had the Halifax saying that the house prices went up 3 months in a row until today, when they've announced that most recently, the last month, they have come down again. And somehow the relentless guff machine of the industry has actually managed to create the impression that, well, we had a little bit of a downturn, but it's all okay now. And Richard Donnell from Zoopla saying just last week, wow, the worst of the house price falls are behind us. Richard started following me on Twitter today, which I was pleased to see. And he's put some really interesting stuff out about 100% mortgages, which we'll come on to in a minute. And I've been checking my assumptions with Housing Stig, who is here. I've got him on mute, so he can't interrupt me yet. But in a minute, he's going to be allowed to interrupt me. Just double checking everything, because it very much feels to me like the downturn is going to turn out, once it's played out, as being one of the worst we've ever seen. Why do I think that? Because I think it's so difficult to factor in the effect of the time lag and to fight off the relentless messaging coming from the media about how house prices are actually going to be okay, we've reached the bottom, and the vested interest guff keeping them propped up. And for everyone who's been waiting for a house price crash, so to speak, they're getting frustrated that it hasn't happened and that affordability's not got to where you wanted to get yet. But this is still playing out as I expected. And there's been recently what some people have referred to as the dead cat bounce, which is just after the first falls have happened. A few people who don't think it's going to go down further think, oh, it's great, we'll buy now and it's okay to buy now. And it's created the impression. But actually, that happened, I think, a few months ago. We're only just seeing it reported now. That maybe we're not going to go into recession, and maybe house prices aren't going to fall, and maybe there's enough demand, and actually first-time buyers have been buying up like mad, and prices haven't been falling as much at the low, and properties above £1 million are selling in 2 weeks, and all of this anecdotal stuff that people have been reporting on, and all of these headlines that are totally misleading because they've got no mathematical context in them. But when you look at the hard numbers, they are all pointing to really significant falls ahead. Now, that's no good for you if you want to buy right now today. And if you're watching this as someone who's actually trying to buy right now today, and you've been trying to buy for quite a long time, and you've got a property that you think's within your reach, and you want to make an offer, and you're finding yourself thinking that, well, they're saying that there isn't really going to be a real recession, we're flatlining, but there's not going to be a recession, and inflation's are going to come down and interest rates are going to come down, so it's probably going to be okay to buy now. Then you're the people I'm most concerned about, because when you look at what's happening in America with house prices, with the economy, and with the whole narrative of what the markets are expecting with interest rates and everything else, what have we seen? We've seen month in, month out them saying, well, that's it for interest rates. They weren't going to go any higher. They're not going to go any higher now, are they? And inflation's going to come down and interest rates aren't going to go any higher. We have the same narrative here. Oh, no, inflation's going to come down really fast. But it hasn't. And interest rates are going to stop going up, but they haven't. Inflation has stayed high and interest rates have continued to rise and are expected to continue to rise. And there are more and more signs, if you look and read between the lines of what's really happening out there, they're going, oh, this is looking really shaky, really, really shaky. And the first question I'm going to ask Alex when he comes on in a moment is, what's his reading of taking the pulse of the overall global financial situation? Because it feels to me as though what happened in previous financial downturns and crashes, which is until it actually tips off the edge, everyone says it's not going to. And those of us saying that it is going to are called lunatic doommongers. Let's bring Alex in. Good evening, Alex. And Lewis, hi, I've got you there. I can see you. Hold on a second.
Good evening, Charlie. A lunatic doommonger. I quite like one of your people commenting who said, unleash the Stig. Excuse me, will I just take this ball gag out? I am now unleashed.
He said Stig, not Gimp.
Oh, God. Wrong film.
So I don't know how much of my rambling you heard there.
Oh, I caught it all, mate. I mean, yeah, you want to know my view on the global situation?
Yeah.
The Western world is not in a healthy state. We are sick. That goes for Australia. They get a slightly different situation to us in that they didn't have the massive drop in the GFC.
Yeah.
They also didn't have quite the same stupidity of 0.5% interest rates, but they've had ridiculous wage growth, and they're in a massive bubble, and they know it. And there's lots of toing and froing there about interest rates and what they're going to do. The same thing in New Zealand, where their property market got massively overheated with people coming across from places like China and Japan and so on and so forth and buying up property. Their property prices went through the roof. Canada enormous debts. All of these countries, personally, loads and loads of debts, and the same thing across mainland Europe. The Western and obviously America. There's it all stems and starts from the US. Yeah, we're not in a good place. We've got vast amounts of debt. We've got governments trying to pretend that GDP is good by propping up housing because it forms such a big part of the GDP. And it's not going to end pleasantly as far as I can see.
Yeah. But I mean, just to play devil's advocate, there are people out there who've been saying, well, we've been saying this, Charlie, you and Alex have been saying this since last year.
What we said since last year was that in half two of 2023, and all the evidence is there on Twitter and YouTube, things were going to start going badly wrong. And I mean, I don't know if you've got the media there, but we had a conversation earlier on Twitter about the number of mortgage renewals that are coming up this year. And you can see that there is just a massive amount of water behind the dam or the levee, whichever way you want to look at it.
Yeah.
And it's going to break. And my judgment is it's going to break around about July, August of this year.
Yeah.
And at that point, we're going to have literally millions of households needing to remortgage on much higher rates. And if you look at the vast majority, over 70% of those mortgages were at less than 2%. So, yeah. So they're going to be going from 2% to, let's say, 5.5%, because I think on Thursday, the Bank of England rates are going to go up again. I don't think anyone would be surprised by that. And I mean, take London. It's a market I know, but take London as an example. If you're somebody here who's got a £400,000 mortgage, which, let's face it, is kind of the bare minimum to buy in London these days. To move from a 2% rate to a 5.5% rate is £900 extra per month on your payments.
Yeah, that's brutal, isn't it? Now, listen, I'm gonna bring Lewis in at this point. So
who actually knows about mortgages?
Lewis, who's a real life mortgage broker. I can tell you, I've seen him and touched him in real life. We shook hands, so I know he is real. Hey, Lewis, how you doing?
You all right, Charlie? Hi, how's things?
Yeah, good, thank you. Good. So
good stuff.
I would. So yeah, Alex is talking there about the number of 2% mortgages coming to an end. How is that much of your business? People remortgaging the end of their low rates?
Yeah. There's we do a lot of remortgage business. It's probably 50-50 to be fair.
Okay.
50% purchase, 50% remortgage, because of course we've got our back book where we've sorted them out 2, 3, 5, 7, however many years ago, and then they come back to remortgage, whether that be to just get a new deal, raise capital, whatever it might be. Yeah, so 50-50 broadly.
Well, so here we've got, let me just, can I get everyone on the screen here? I'm just going to show a couple of these stories right here today. So this is John Stepek's story that came out on Bloomberg today. And this is what I'm worried about. And I know, Lewis, you take this very seriously. You look ahead at your customer, your mortgagees, people taking out mortgages with you. And one of the reasons that I first started talking to you and was keen to work with you is because you expressed a genuine care about preventing people from getting themselves into trouble with what's coming down the line. So, and when we had the live Q&A with you and Graham, whenever it was last week or the week before, you guys actually said that you don't think house prices are coming down as much as I do. You don't see it yet, is what you said. You didn't actually make a prediction about the future, but you're not seeing it yet. And I've had a couple of questions here which I want to ask, which are talking about the same thing. But what I'd like to ask you is your view on, or your reaction to my view that the reality as this story says on Bloomberg, right? And as investors around the world were surveyed, and everyone's expecting the UK to see a massive drop in living standards. Now, call it what you like. It's real wage shrinkage. That's what we're going to see. It's real terms wage shrinkage. We are literally, as a country, going to be poorer. And this is, it's exactly what Alex and I have been talking about for a long time. It's what Alex has predicted with his death in poverty, his whole welcome to 2025 thing. And I don't think it's easy, especially for a first-time buyer, to actually grasp what it means. And if you've never experienced Britain in the grip of a horrible recession, you hear about it, but it's not really real, and so you get fixated on getting into your new home. And I genuinely worry for those people, and there's not all of them, but some of them who are going to be unconsciously optimistic about the fact that it's going to be okay, and they've managed to get 5% below asking price, so they're not that exposed to negative equity, so they're hoping that they're going to be okay because their job's pretty secure at the moment. But fast forward 1 to 2 years, and I think the world looks very different, and I'd just love to know what your view is and what you're saying to your clients about this.
Well, I take a bit of a different view. I'm not a macroeconomist by any stretch of the imagination. I'm, far, far from it. However, given that we printed a lot of money during COVID, not just the UK, globally, trillions was printed. And a lot of that money is still sloshing around. And as a rule of thumb, it needs to find its way into assets, because the bulk of it ended up with, it seems to be wealthier people. So I think that over the kind of medium term, we might see prices come down a touch in the next couple of years. But I think over the medium term, house prices will probably still trend upwards, for the simple reason that wealthier people who have ended up with a lot of this cash want to put it somewhere. And bricks and mortar is, over the long term, generally a pretty solid investment. So for that reason, I don't necessarily think that house prices will, I can't see them not being affected by what's happened. That's the first thing. I can't see them not being affected. I just don't see it to the same extent because of the amount of capital that's still needing to be allocated. And when it finds its way into assets, what do rich people tend to buy? They don't keep money in cash, they buy assets, and they're going to keep buying up property. So with that in mind, whilst there may be a bit of a falter, I think that broadly speaking, they'll probably trend upwards. Now, on that, when it comes to kind of first-time buyers, I generally take the view of everyone has to live somewhere. Now, there's obviously a proportion of people that are going to be living at home with their parents still. Mm-hmm. But for people that are renting, you're paying out either a mortgage or rent.
Yeah. Now,
until obviously rates went a bit crackers following the mini budget, broadly speaking, a mortgage was definitely cheaper than rent, well, excluding kind of certain parts of London. But in the main, so if you're going to be paying out that amount of money and you need a roof over your head because you need shelter, then I always took the view of it's better to own an asset than not own an asset, because I think that the trajectory of our economy is certainly becoming more asset based. You're more rewarded for the assets you own than from the labour you expend and the income you earn. And therefore, I think it's better to be an asset holder and be on the ladder than not. Now, of course, people are going to say that I'm biased. Yes, of course I'm biased because it pays me money to do this. Yeah. But I'm not saying that. I'm honestly not saying that because it benefits me. That's genuinely what I think.
Yeah. No. I don't doubt that for a minute. That is what you think. Can I ask? So Alex, did you hear all that?
I did. Yeah.
And what's your reaction to what Lewis has said?
Well, okay. So we've had 2 rounds of printing lots of money. The first happened obviously after the crash 2008, and they printed, I think, some 425 billion. Now that went to the banks, and then the banks decided not to lend it, which is why in real terms house prices continued to fall until 2013. They didn't actually start to rise until 2014 when the Help to Buy, and then they only reached their 2007 levels in real terms in 2021. Now, what we've just had with the additional 550 billion, I think, of printing was very different, as Lewis has said. It actually went into the hands of people in furlough money, in bailout loans. So it wasn't quite so much the fact that the bank could deny you getting it. It's in their bank accounts. But if you look at the wealth of this country and the cost of living, we currently have nearly 18% of all adults have less than £8,000 of assets. Now that's everything they have. I'm not just talking about, this is their savings accounts, their premium bonds, their pension, their house. Now that's a large number. It's pretty high across Europe. and we have 40% of people who have less than £80,000, $100,000, which again is impressive in terms of how little money for a rich country we have. But more importantly, if you look at accounts and you look at the use of credit cards, it appears that all of that furlough money for the people who, as Lewis pointed out quite correctly, the very rich appeared to have got quite a bit richer, and maybe they want to buy themselves 1,000 houses. But the people, the vast majority, the bulk of people, are about to run out of all of that furlough cash. It's gone. We can already see it with the credit card spending, which means they don't have the money to be buying houses at this point. So I think, we're somewhere in between. So I think Charlie has the worst projection, which is a 35% nominal crash. I'm more in a 30 to 40% real. I think Lewis is obviously on the much, much softer side, and that there will be a slight impact, but then it will rise. But we all have different views of why this is happening.
Well, listen, so I want to address this often cited theory that rich people are going to pile in with their cash and buy it because they want assets, just like Lewis has said. And I get what he means, but
why would they buy houses?
I was going to say, right. So I know a lot of rich people. I've grown up around them, and I can tell you the one thing rich people don't want is hassle, number one. Okay. And owning property is hassle. So unless they put the money into a real estate investment trust or something, then they've got hassle. They've got either tenants to deal with, or agents to deal with, or property maintenance to deal with. And it's not a simple investment property, right? It's got real hassle and risk alongside it. Yes, in the long term, but to back up this, to go to the second point, which is in the long term, property always outperforms. Look at what I got on the screen there now, right? That is how much £1 invested 50 years ago. Mm-hmm. Sorry, is that 40 years ago? 40 years ago is worth today, and that's adjusted for inflation. Property is worse than the UK stock market and UK income stocks and technology stocks, like way worse. Actually, where rich people tend to put their money in assets is into stocks or commodities, because those are simple, low maintenance assets that are also easily and readily liquidizable, right? Because you buy property and you want to get out of it. You can't just get out of it like that. You have to wait 6 to 12 months to get out of your property. So it's a very popular myth that, oh, well, when house prices fall, rich people are going to pile in with all the cash that they've got. It just doesn't happen.
They didn't in 2008.
No, exactly. It doesn't happen, because the thing about rich people, above all else, is they're lazy. Okay, they're really lazy. They don't want hassle. They don't want work. They don't want people to deal with. They just want to put their money somewhere and see it go up. And again, property is very much a middle class thing. And when I say middle class, I'm not talking about the rich, the super rich. In other words, the people with hundreds of thousands or even millions of spare cash to invest don't go into sort of small landlord portfolios of properties. It's just not what they do. They want to be in their villa. They want to be really just enjoying their money. They don't want hassle. So I've never seen any evidence of large scale. Now, the one thing that might be different this time is, as Tom W just put on there, the banks buy it all up, and the World Economic Scrotum says we're happy and earn nothing. Right? There's
now on that, you see, now Lloyds Bank have already said, I think it's Lloyds Bank, that they want to become the largest landlord in the UK.
Yeah.
Now, if you've got unlimited checkbook, as they have, then that will factor into it. But also, we have been building houses now for quite some time, yet property ownership rates, owner-occupier rates have fallen, yet those houses haven't disappeared. Someone owns them. Mm. So with that in turn, so it's taking that kind of stuff in the round, that there are going to be significant investments with corporate landlords.
Yeah, there will.
Quite a large number of those, though. I mean, let's not forget, first of all, I've always been a believer that large institutional investors will become large private landlords, and that will be the way that the UK goes. And we'll end up a little like Germany with more renters than owners. But aside from that, there are 35% of all buy-to-let properties were originally homes. It was, I would imagine, people who started off as single or in one relationship, bought a flat. For whatever reason, they then formed another relationship, moved out of that flat, decided not to sell it. They were going to rent it. They moved in with someone else. So it's not that there are necessarily lots of rich investors coming in. And that's why you said, oh, well, we haven't been building that much, but we still have more rental properties. It could be, given that 35% of them are these ones that were originally homes, they were not bought to be buy-to-let properties, that's just a natural growth over time.
Yeah. Well, so there's lots of other topics I want to cover, so I don't spend too long on this particular topic, actually. I would like to move on, if we can, and Lewis, I'm extra glad you're here for this, to the 100% mortgage product that's been widely reported in the press today. And
Sure.
I should defer to you as a mortgage broker. I'd like to just ask you for your opinions on the fact that they've announced it and whether you'd be recommending it to any of your clients, and if not, why not, and if so, who, and just I'd love your opinion. You and I haven't discussed this, so I've got no idea what you're going to say. I'd love to know what you think.
So I don't think it's inherently a bad idea. I think it's ill-timed, personally. But the stipulations, the policy that's surrounding it, it's so restrictive that it's unlikely to cause a major issue, in all honesty, because the number of people that will A, qualify for it, and B, in terms of the prices that they'll be buying at, I can't see it really having a huge detrimental effect. So and here's the thing, the product it's a 5-year fixed rate. That's all that's available. And the redemption penalties on it are pretty significant. So off the top of my head, in the first 5 years, the redemption penalties are 6%, 6%, 5%, 4%, and then 1.75% in the final year.
Wow.
So there are going to be significant penalties to get out of it. So would I recommend it? I wouldn't discount it. However, I would have to be pretty certain that whoever was getting into it, specifically if it was a couple, that you're aware that it's mainly pointing out the risks. If you split up, because young couples tend to split up, that's unfortunately the fact of life. And therefore, we see it all the time where, we arrange a mortgage, might be a 5-year deal, whatever it might be, and then you see them during that period of time, obviously not always, but it's something that we see regularly where they've gone their own separate ways, they're splitting up, etc. And then there's this kind of notion of, oh, well, I'll just buy you out. Unfortunately, it's not that simple. Or I'll just take myself off the mortgage. Again, that's not that simple. Yeah. So where there are significant penalties, it's to understand, look, if house prices stay flat or reduce and you're paying a relatively high, well, it's one of the highest kind of mainstream rates on the market for it at 5.49, I think it is. Don't quote me on that. But the amortization of the loan is pretty slow, given that you're going to have to stretch it out to 35 years to get the borrowing, the maximum borrowing. Therefore, there'd be the likelihood of breaking even if you did need to jump out of that during the 5-year fix is almost nil, I'd say.
Yeah, right.
So you'd have to be very committed to a relationship if you're doing it as a couple. As a single person, and they've got the income, and their rent is just killing them, and they can't actually save up, then yes, given that it's over a 5-year time period, again, if it's the case that the rent is going to be equal to the mortgage, again, I would always go with, buy a property, because at least that way you've got at least.
Surely, depending on the viability of their job in what is likely to come in the coming market. I mean, that wage shrinkage is not only because wages are shrinking, it's because people are going to be made redundant and there's going to be more unemployment. And what you were talking about in redemption penalties there, for an average property in the UK would be somewhere between £16,000 and £18,000.
Yes, but because the way that this product's been structured, you're not going to get anywhere close unless you're paying absolutely astronomical rents, and I mean hugely astronomical rents. Because the way it's been structured is that when you rent a property, you have to go through the rent checks and have an affordability check. So there's a couple of fail safes kind of built in, because in order to be renting that property, you must be able to have the income to afford that property. And because you can't exceed the rental payment, the actual amount that you can borrow is significantly reduced. So, for example, it may be the case that on your income, you could borrow £200,000, but if you're going for the 100% product, it may be that they're capping that at £130,000.
Okay.
So you're not going to get anywhere close to those figures.
So you're right. So it means that there are going to be even fewer people. When you talk about how strict it is to get this mortgage, there really are not going to be very many people getting this mortgage.
Yeah.
No. So for example, if I put this in to put this in kind of context, I actually tweeted about this earlier. In fact, I'll get the calculator up now. So what's a typical rent in for a 2-bed apartment in London?
1850.
Okay, 1850. So the maximum that you'd be able to borrow on that, assuming you've got the income to support the affordability, would be £344,000. So that's not going to be in most parts of London. It's just not going to work.
No, exactly.
Whereas in, for example, parts of the north where you might be paying, say, £850, that's going to give you a max loan of, say, 158. Now, you don't have to have zero deposit. You can have up to 4.5% deposit. So it might not be the high 5%. So where you're paying £850 in rent, you could buy, say, 150, 155. Now, actually, in areas that, certainly the area I was born in, you'd pick up a 3-bed semi for around that price. You'd definitely get a 2-bed terrace. You'd certainly get a 2-bed apartment. And so this is not going to work. I suspect this is not going to work in the south. It will work in the north. Now, when it comes to kind of redundancies, this is why I don't think it's actually that bad. I did think it would be worse than this. But if you think of those areas, they're predominantly industrial areas and logistics areas. So, for example, the area that I'm from, lots of people work in logistics, in kind of big food distribution, all that kind of stuff.
Yeah.
So whilst there may be redundancies, everyone's still going to need to eat food. So the people I think that this is targeted at, actually will probably be okay.
Okay.
Right, guys, let's quickly, because the Halifax came out today, and this is actually relevant. And I'll be the first to say that I'm always the first to say 1 month's movement isn't significant in itself. So I'm going to contradict myself. Because this is the house price index that came out this morning on the Halifax, and there is a monthly change. Sorry, let me just get my so there's the purple line there. You can see, so monthly prices went up and now they're coming down again. That's in percentage growth or shrinkage. I want to find that other graph. Have they got it? I can't find it. It's. But the point is this: everyone, in fact, even the people who were expecting house prices to rise, were surprised when the 3rd month in a row Halifax house prices reported a rise after Nationwide had been reporting 7 months straight falls, and then Nationwide had a slight up, and everyone went, "Well, Halifax and Nationwide are both saying they're up now." And I was, as you have, Alex, as well, been pretty confident these are just wrinkles in the trend and not a reversal of the direction of house price movement. And so now we've got Halifax is now having had a slight bounce and heading back down again. Remembering that at best these are 2 to 3 months out of date, number one. Number two, they're not for completed transactions, that's for their approved transactions. So there is some variation. And number three, both of those indices have got all kinds of weird seasonality changes and stuff. So it's not actually exactly what happened in the month. And when you're in this strange high volatility market that we've been in now for the last 6 months or so, I think these are you've really got to zoom out further to see the real trend.
Yeah, I mean, Charlie, you know that every month I do the land registry data.
Yeah.
So, unfortunately, that means that we are months behind because the last release was only February. And as you also know, it's a very small subset of the whole of February because you only have about 8,000 records.
Yeah.
Now, in there, you did see actually an increase from Jan to Feb. No two ways about it. But from October, November of last year, you're still substantially down. About, I think it's 3.7%, depending on whether you're looking at terrace, semi-detached, detached, or flat. But there's no doubt it's going down. But we're at that point where people are holding off remortgaging. I don't actually, Lewis, looking at the data that I've got, it appears that people are not remortgaging at the rates that they should be remortgaging, given the number of mortgages that were taken out 5x years previously. Does that hold true? Does that make sense to you, or is that wrong?
No. So I think what's happening here, and this is we've noticed this myself, other colleagues across the board, we're doing a hell of a lot more product transfers, so it wouldn't show up as new mortgage originations.
Okay, so does that mean that these are people who they're not waiting, but they're just transferring to a new product, or?
Yes. So what lenders have cottoned onto? So it used to be the case. A few years ago, good few years ago now, probably 3 or 4 years ago, that lenders were all they were bothered about was new business in the front end, and then when it came to you finish your fixed rate, and they would offer you a retention rate, a product transfer. Yep. But they tended to not be particularly well. They were never very competitive at all, to be quite frank, because they relied upon people having apathy and just going, "I'll do that because I can't be asked with remortgaging." But then what happened is when everything got much more competitive, and of course there was a big surge, so we kind of had a big jump in terms of how many intermediaries were dealing with mortgages. It then became the case that actually, well, I'll flip you from this lender to this lender because we're going to save you 1.5%.
Yeah, absolutely.
Whereas now what's happened is mortgage lenders realised actually because they're paying money out to brokers and the number of mortgages originated by intermediaries is now about 85-90%. They've realised that actually
it's better to
retain much more profitable to retain people. So what they're doing now, so for example, I did this, it was 6 weeks ago or so. I did a product transfer for a customer with a large building society, not the biggest, but certainly a big building society where their product transfer was better than anything that was available on the open market, purely because that lender doesn't have to do anything to retain that business.
Sure.
So what we're seeing is people are still fixing into new deals, but they're just not remortgaging from lender to lender.
Okay, so that means that the FCA stats and the Bank of England stats that cover house purchases, remortgages, and other, this number would not appear, these transfers, because it appears that they're still on their original mortgage. So that number would not appear anywhere.
Yeah, that's correct.
Perfect. That explains. Thank you, because I've been wondering where the hell they'd disappeared to.
So, guys, someone, Mrs. M asks, is the cat definitely dead? As in the bouncing cat. And I think this graph, which is from Halifax, the red line and the blue lines are interesting, right? Because the red line is percentage year-on-year increase. And if it's above the black dotted line, it's positive. But actually, you can still see that last October, November, and December, Halifax was in negative territory, while annual was still positive. But if you look at that graph, where do you see? I mean, so the year-on-year price in Halifax was apparently compared to the last year, prices are 0.1% higher. Okay, so in other words,
it's like our GDP.
Yes, yeah. Just avoiding negativity by the skin of our teeth. But like, where does that red line go from there? You look at that graph. Is it about to bounce up?
That does not look like a game of Pong to me. I'm not seeing that bouncing back up again.
And not only that, because the year on year, okay, the month on month and year on year is different time frames and stuff, but that's not coming up. That's going down. That's going negative. It's just something to do with the monthly and the anyway. That's so. I think this point I'm trying to get to is the Lewis. You've heard Alex's explanation about the connection between wage price growth and house price growth, right? He's gone back 27 years and done the data and just gone. I mean, the way Alex works, right? Because I've known Alex a long time. The way Alex works is he goes, I have no opinion. I will look at the maths and I'll see what it says.
Yeah.
And that's what he did. And because Alex, when you did this, you weren't expecting to find that correlation, were you?
No, and again, you have to understand that I'm a complete idiot in this, as you just explained to me, you had to explain the mortgage transfers, why I was not seeing where, these numbers had gone. The same thing with all of these other stats. But what I can see is that in 2007, we had a 4.4%, and into 2008, sorry, a 4.4% real wage shrinkage. And that resulted in a 22% drop in house prices. Now, there were plenty of other reasons around that, including the vast increases from 97 and so on. But we've just experienced again a 4.4% decrease in real wages using CPI. And all I did was graph these together and look at the correlations. And no, I had no idea where they would come out. That's with a 0.974 correlation. It's showing a drop of between 30 and 40%, depending in real terms, depending on what happens with inflation, depending on what happens with wages, depending on what happens with interest rates. But interest rates take so long to work through the system that, to be honest, that doesn't change anything. We haven't even really felt the increase to 4.5, and won't do for many months.
I do see where you're coming from. However, the 08 one was specific in so much as there was obviously real wage reductions, but it was mainly predicated off the back of banks unwilling to lend. So if the financial system seizes up and no one can lend, then borrow as much rather, then of course that's going to lead to significant price falls. However, currently, assuming that they're all being honest, then the liquidity for mortgages is fine.
So you're not
there's
seeing,
no real issue.
with the exception of this silly 100% mortgage, you're not seeing any tightening of restrictions in terms of lending. If somebody rocked up to you today, the same person, same history as somebody as in 21, they would get the same mortgage with no difficulty.
They would likely be able to borrow the same amount. I mean, to be fair, the ONS data has changed affordability. So, and again, mortgage lenders have tightened a little. However, most people, and I speak for, I've not worked in London now since 2016 in mortgages. So excluding London, because that's just a beast on its own.
Weird.
But excluding London, broadly speaking, most people aren't pushing themselves, typically couples, they aren't pushing themselves to the absolute limit. So as a consequence, most people can borrow around the same. Now, whether they want to borrow the same, because the
payments are so much higher.
Yeah, that's a different kettle of fish. But can they? Most cases, yes.
Okay. So to some degree, the whole American banking situation really is the thing that we've got to keep watching. We saw Credit Suisse keel over. Deutsche Bank is still looking flaky despite all the protestations to the contrary. The UK banks are well funded at the moment, but hey, there's plenty of time for that to go wrong.
I think as well, something that's been that sometimes is a little bit overblown. So if you imagine someone took out a £400,000 loan, let's say 5 years ago, and it was a 5-year fixed rate, and they had it for 35 years. Yeah. Now the repayments at that point in time, 5 years ago in 2018, would have been £1,429, 1,430 quid.
Yep.
But after those 5 years have elapsed, that loan is then £361,000. So if I then plug this back into my calculator, £361,000, and let's say that rate has increased to, broadly speaking, again, stuff at 4.5, but of course the years have reduced to 30. So that goes from, for example, 1430 to 1830. So an increase of 400. So it's not, 400 quid, it's not an insignificant amount of money. However, what's happening often is people are going, £250,000 mortgage 5 years ago versus a £250,000 mortgage now. But of course, that loan has decreased over time. So whilst if you were comparing just the two £250,000, yes, there's going to be that kind of £600, £700, £900 difference. But because the loan has amortized over that period, then the increase isn't quite as bad as it's being made to look in the media.
That's true. The example I gave earlier was for a £400,000 loan because it was in London. But this is where it worries me. What people have in terms of savings and wealth is we're talking about £5,000, £400 a month is still £5,000. Add to many of us, we might go,
Yeah.
well, £5,000 is not that much money. However, to a large percentage of the population in the UK, that is the difference between having the home or not. But more importantly, it's about that's £5,000 that they might have spent in restaurants, on clothes, on holidays. And that's where the recession starts. When people stop spending, we talk about banks refusing to lend. That's true. That makes a big difference. But people stopping spending in the community means that jobs get lost, and that businesses fold. That's where it becomes a cascade.
And this is the reason why I think it'll be worse in, for example, places in certainly in major cities, because that's where it'll be. But in kind of in the normal suburbs, this is why I think it'll be regional. So I don't doubt that London could certainly see a big chunk of the property values. I don't think that's a bad thing, but I think it will be regional, and I think it'll be more based upon the demographic of people. I don't think industrialised areas will be actually hit this time as they were last time in 2008.
No, that makes sense. The north. I mean, when you look at the property prices, it's very stark from the Midlands down versus the Midlands up. The prices are just chalky. When people say, but the average price is 286,000. No, it's really not.
No.
Yeah.
Right. Oh, look, there you are. Kicking Mustang says Stig is 100% nail on the head here. So there you are.
Thank you, Kicking Mustang.
Still on the money.
Great latest airsoft video, by the way.
Guys, there's so much to talk about here. There's so much to talk about, and we've been going for 45 minutes now, which is great. I wanted to. So we've touched on that Halifax. I think the dead cat bounce has happened, and I think it goes. Okay, this is the point I wanted to make. People making a decision on whether to move today or not, whether to buy or rent, or whether to buy and sell, or sell and buy, are looking to the news to find out what's happening with interest rates and mortgages and house prices. And therefore, they're making a decision on an event that will be happening in the coming months in their life, based on information that's coming from a time several months in the past.
Yeah, absolutely.
Everyone is making their decisions. Shall I move now or not? Shall I buy or shall I rent? Shall I remortgage or not? Shall I sell and then buy later? Shall I move into a fucking van and live there for a while? Like, all of these decisions are being made, and everyone's like on the news, all over it. And this is why the papers print out so much stories about this, because everyone just laps it up. But we are lapping up data that's reported today. Halifax house prices out today. Yeah, but it's for several months ago, and the world's already changed in that time. And this is what makes it so difficult, and it's what worries me so much, because there are people making the decision to proceed today with an exchange, for example, who, if they actually had access to the information of what's happening at the coalface today, wouldn't proceed. And that is, there's this, it's the time lag, which is the trap that a lot of people are going to get caught in. Without going into the details, just keeping an eye on world events, world economic events, financial, banking, legislation, all this stuff, it's all gradually, but in hindsight will look like happen quite quickly, it's all gradually moving in the direction of trouble for the financial system, the banking system. No one over here is really in the mainstream media talking about the rumblings in the banking sector in America. But when they go pop and bang, which they're going to at some point, that's going to have a fallout effect.
Yeah.
And yet no one's like, is that affecting, like, are there any of you watching this now, considering your move, or like, shall I offer or shall I move or not, who are going, I wonder what's going to happen with the American banking crisis? I mean, some of you guys maybe because you watch this channel, but of the larger market of movers, I doubt it. Your average first-time buyer, I doubt it.
No, but Charlie, and this is the problem. In the same way that the Fed deliberately obscures their meaning when they give their chat. And our Bank of England does the same thing. They will have two different people from the Bank of England committee. One will say, oh, Christ, well, we're going to have to go harder and raise rates. And the other one will say, no, I think actually we've probably gone far enough now. They keep everything obscure. The same thing with the banking. At the moment, people are saying, well, it's okay. We had that blip because of these terrible short sellers last week.
Yeah.
But actually, it's all come back again. Sorry, come back. These banks are still over 50% down on where they were only 6 months ago.
Yeah.
And
no, it's fine, Alex. It's all fine. It's all fine.
But the argument is, well, no. It's a blip. It's a blip because actually they have good liquidity. They're absolutely fine. They've got reserves. This is market traders just gouging the market in order to make money.
Yeah.
And the problem is, we can sit there and say, well, I don't believe that's true. I don't believe that. I do think some of these smaller banks will continue to fold and be eaten up by JP Morgan and by Citibank. However, we don't know that. And this is why advice, even for, as I'm sure Lewis, as a mortgage advisor, will say, advice is very hard to give because it really has to come down to the person taking the advice is at some point going to have to own that and take the responsibility for it because they're going to live with it. So, yes, do I believe that the banking crisis in the US is going to overflow and will impact Europe? Do I think we're heading for a credit crunch where banks will be less happy to lend to anyone who doesn't have a perfect credit score? I do. Do I actually have proof of that right now? No. Difficult.
I mean, I think when it comes to mortgage rates, as you mentioned, we've not seen the last of it. If you look at the 2, 5, and 10-year gilts,
exactly.
Today, they spiked up in September when Kamikaze had a good, give everything a good kicking. They did calm down, but they're now kind of drifting up again. And also, if having a quick gander at the SONIA swaps again, 2-year SONIA that's jumped quite a margin. So
have we hit 5% on there yet?
No, not on SONIA. No. I think 2-year is about 4.5. But again, so the Bank of England base rate rise that's almost inevitable on Thursday will put further pressure on lenders because currently they can't be. They must be lending from reserves because they can't be getting it from the commercial market because they just can't. The rates are such that you couldn't fetch that in and you'd be loaning it out at a loss. So
this is why America, with its 30-year fixed rate mortgages at 2.5%, and the Americans are all laughing over the internet about how well they've done. It's like, but your bank's not doing very well.
Yeah. Right, guys. I want one more topic I want to come on to before we wrap up for this evening. And it's the topic of the housing shortage. And Alex, this is really for you. I want you to respond to this. I did a video only a few months ago talking about how we could double the number of properties in this country only using 1% of the countryside, right? If we built on 1% of the countryside, we would double the number of dwellings in the country. So in other words, there's no excuse for there's not enough space to build. We don't want to cover the whole countryside. That's not going to happen, right? And this is a time when I really believed, as you will remember, Alex, I believed that rampant house building is the only way to solve the housing shortage.
Yep.
Now, you've changed my mind. And I still see people like Henry Pryor and a lot of people, Emma Fields, going, got to build. And I do agree that there are certain particular crunch points in certain cities where we need more flats quite quickly.
Yeah, I am not averse to building. I just think that there needs to be some logic behind how many properties you build, rather than setting an imaginary target of 300,000 and exactly. failing to hit it. Because, very sadly, we have a large demographic of older people.
Sorry, let me interrupt you. Let me finish what I was saying.
Yeah, go on.
And then I got a specific question that I'd like you to answer, which is, so I also there was a video a few weeks ago I did where I showed that actually in England and Wales, somewhere about 70% of all properties are under-occupied.
Mm-hmm.
Only about, I think, 11% are occupied correctly, not under or over, and a very small number are actually over-occupied. Which is the point you've always made, which is actually there's plenty of room. It's
Yes.
just not evenly distributed.
We're not allocated correctly.
Yes. And then we started looking at birth rates and projected population growth and that kind of stuff in decline. And of course, there are a lot of people who are just convinced that immigration is entirely the problem behind rising house prices and shortage of available housing. And there's no doubt that there are areas that that's true. But as a country as a whole, I don't think it is. But my question to you is, even if there was a rampant new house building announced tomorrow by the government, right, we're going to fund an unlimited amount of building, we're going to remove all planning restrictions so people can build wherever they like, as fast as they like, and just get out there and build. We're going to pay them to build, and we, the government, are going to buy the property so they're going to be able to sell them. We're going to say sod house price. I know this wouldn't happen, but hypothetically, sod house prices, build everything we need. The amount of time it takes to find the land, get the buildings actually done, up, ready to move in, is something like, I think, 4 years, 5 years.
No, it shouldn't take that long.
Because of the planning process right now, right? So,
but even with the planning process, it shouldn't be 4 years. And it all depends on the quality of buildings you're looking for and where you're putting them, as in, is there infrastructure there already, or are you having
infrastructure?
But
here's my specific question for you. Do you think even if such a massive building spree was undertaken starting now, would it actually produce new homes in time before the population decline that we've discussed would actually start to naturally solve the housing shortage?
It's like everything else that we're discussing at the moment. It's right on a knife edge. If you look at the population of boomers and the silent generation, who unfortunately are now dying, and the large houses that they are going to free up, and you look at the number who are dying annually, which is between 500 and 600,000, and you multiply that through, 4 or 5 years is about that time period. I mean, what you're talking about there is 2.5 million properties, which is 10% of, almost 10% of all of our properties. And it's not that every single one of those people owns a house.
Can I just clarify? Sorry to interrupt you. 2.5 million properties you think are going to be released by natural causes, people dying of natural causes?
In 5 years. Yeah.
Over the next 5 years, or 5 years?
It'll be a bit less than that, because not everyone lives alone, and not everyone will be living alone at the end of their life, and some of them will be in care homes. But let's say 300 to 350,000 properties in the next 5 years from today. Start today. In 5 years, that's the death rate in the UK. And yes, there are the occasional people in their 20s, 30s, and 40s who die, and even children. Yeah. But the vast majority of the 500 to 600,000 people are people over the age of 65.
Yeah. So if you are a home builder and your investment cycle till you start to see returns is 4 or 5 years, it's squeaky bum time, isn't it?
Yes, well, that's why we're not, at least. And again, Lewis, perhaps you've got some insight here. What I'm seeing from the house builders is not a great rush to be building lots of new properties right now.
No. Help to Buy put pay to that.
Yeah.
Well, the end of Help to Buy put pay to that. Because actually, for most people, the premium attached to new builds is such that unless you've got a significant deposit, then it's pretty much out of the question, because the vast majority of lenders want 10-15% deposit, which on a new build that's 350,000, 400,000 pounds is a significant amount of money. So I've not done any new build mortgages now for Christ. I did one new build mortgage last month, and in the last 6 months I've probably done 4.
Yeah, that
contrast to say 2 years ago, where I'd be doing, of the 50% that I do as purchasers, half would have been new builds.
Yeah.
Wow.
I mean, yeah, it's dropped off a cliff, mate. I mean, the guys I know who are doing that residential, most of the people I know are commercial, but they obviously speak to the residential guys, or their companies have residential arms as well. There is no appetite to be building new property right now. So your hypothesis there, or your sort of, if the government were to come in with unlimited money, yeah, sure. I mean, I'm sure the builders would build it if they were given unlimited cash and promised, profits and all that sort of stuff. But why? Why would you bother?
One of the bigger problems is as well that no one's building bungalows. That's one of the that's
Yes.
the biggest choke point
Old
in the
people
property
could
market.
actually move into a bungalow. Yeah, makes sense.
But they're not profitable because they take up a huge footprint, a significant chunk of land. If you're building one story, you might as well build two,
Yep.
because the bottom story is the most expensive to put in. So without a surge in bungalow building, we're going to have this where it's all out of kilter in terms of occupancy rates.
Yeah, agreed. I mean, yeah.
So, okay, so is it a valid argument to say that actually, if net immigration stays at the average it has the last 5 years?
Yeah, not like last year where we had the bumper crop of 500,000, but 250,000.
Yeah. If net migration stays the same, net immigration stays the same, then what? So let's work this out. What's that going to do to prices?
Well, it should. You would look. There are going to be some families where they will be able to take on their parents' old house. You know, they will move out of the smaller house that they're in, and they will take on their parents' house because they've got kids, and however that works. But there'll also be quite a lot of people, depending on what happens with inheritance tax, who are forced to sell the property. They won't have any other option because, you know, they can't split it between them or however it works, or they have inheritance tax to pay and they can't afford the inheritance tax. Yeah. And that's whenever you have more properties hitting the market, you've got to think that certainly isn't going to support price rises.
Yeah. And so just when, so we're predicting that house prices are going to fall in the next couple of years, down to 2025, and then start to bottom out and plateau 2026.
Yeah, through until my view 2030.
Just when the housing shortage starts to ease and supply starts to look in the market, and so there's going to be nothing to put house prices back up again, even if wage growth has, let's say wages are now by then.
If wages increase, house prices will naturally follow because people they start to bid. It's like any auction. If you had an auction and everyone in the room only had £1,000 to spend, you know what the limit on the thing you're selling is. But if everyone suddenly has £10,000 to spend, then you're probably going to get more money for whatever you're selling. If wages go up, house prices will go up for no apparent reason other than people have more money to spend.
Yeah.
One of the things that we also have to factor in here is the rise in equity release. That's the one thing that does actually worry me, equity release.
Okay.
Because as people have taken on in the last 5 years or so, last decade or so, as people have taken on larger and larger mortgages and indebted themselves further and further, often with a view that at some point they're going to get some inheritance. But of course, people's pensions aren't as good as they were. People are reaching retirement age and actually seeing that the cupboard's bare, and then they're turning to equity release, which is why we've seen a huge explosion of equity release.
It's a terrible thing.
So this is the one thing that does worry me that's coming down the line is that there'll be a lot of people expecting to get inheritance that actually won't be there. Yep. And this is where I'm talking about kind of a big allocation of houses ending up in the hands of corporate bodies.
Yeah,
where there won't be a necessity to sell them because they can rent them. I'm not suggesting that will happen, but it does. I mean, that's the I suppose a slightly conspiratorial idea.
But that is all part of my death in poverty. My view is that, as you say, people will not be receiving inheritance from parents over the next sort of decades, maybe this decade, but not next, perhaps. Their pensions will be worth nothing because they're more self-employed, and they won't have been able to buy property, or at least if they have, they've got a mortgage that extends into their retirement. And suddenly there is no comfortable retirement. There is nothing with, you know, and I hope it doesn't happen, but it does look that way. And equity release, as you say, is one of those mechanisms where that can happen.
Right, guys, because we've gone way over the hour mark, I've got 3 questions that came in that I flagged. They're all from quite a long time ago, but I'd like to ask. I don't even know if the people will still be watching because it's quite late now. 1984, this is a short question. I'm going to answer this one. 1984 on YouTube says, how much of a bounce will the housing market get from the new 100% mortgages? None. in my view, for the reasons that Lewis outlined, which is that very few people are actually going to get that mortgage product. Such small numbers, it's not going to make any difference. My view is it won't make any difference. It's not going to be that there's suddenly going to be a huge increase in the number of people buying because that mortgage has become available. I don't think. Unless either of you guys disagree with me, I'm going to rush on to the next question.
No.
Okay. Hatterbez29 says, Charlie, seriously, why are houses still selling well when affordability is on the floor? I see mortgage applications as part of my job, and somehow they're still pushing mortgages through. Lewis, do you have an opinion on that one?
I mean, so last month I arranged 24 mortgages, and the affordability for all of them, bar a couple were tight. Everything else was okay. I mean, but then it's regional, so it depends upon where you are in the country. It depends upon the wages. It depends upon a lot of variables. But in my anecdotal experience and of my colleagues that are scattered across the country, it seems okay. At the moment, it does seem okay.
And Alex, do you reckon this is just the majority of people out there who are basically don't think anything bad's going to happen? They're just going to keep on pushing through and pressing ahead with the borrowing money and
Correct.
Yeah.
And as I say, the furlough money is only just running out, and people, as you keep pointing out, for these people to be buying now, they've made the decision some months ago.
Yeah.
And so they're now pushing ahead. You've got that sunk cost I've been involved. I've found the place I want. I've got the mortgage in principle. Let's go. And that's why July, second half of this year, July, August.
Yeah.
That's where it all goes wrong.
One more question, which is a question for each of you. I think that means you and me, Alex. What signals over the coming months would make you change your mind from your current position? It's a good question.
It would require real wage growth across both the public sector and private sector. So if companies decided to beat inflation, whatever inflation might be, and the government decided to raise everybody, all the public servants' salaries above inflation, then that could hold off a house price fall. But that is the only thing.
But surely that would be inflationary in itself.
Of course it would. But let's not. This is, well, I mean, we're not trying to do a reality here.
No. Okay, but that's the only thing. If real wage growth turns positive in both the public and private sectors, sustainably positive, that
above inflation.
Yeah,
I mean,
Yeah. And okay, all right. So, guys, I mean, I could keep chatting for ages, but I think we should probably wrap it up. I wanted to let everybody know that, as well as Lewis, who's one of the two hand-picked mortgage brokers that I use, who I trust completely, I've now, as of this week, also, some of you will have seen, I've now got search packs available, but I've also just this week signed an agreement with a national conveyancing company. I want to make a point here, though, very important point, which is, let me just get that thing off the screen. Sorry, I'll just hide mess from the stream. And Lewis, you won't mind me saying this, right? But the people that I recommend on Moving Home with Charlie, whether they be mortgage brokers like Lewis or the searches company I'm working with, or the new conveyancing company I'm working with, they're always my second recommendation. My first recommendation is that you find someone that you've chosen yourself that you like, right? But whether it's mortgages, I always say, find an independent whole of market broker. And if you find one that you like, go with them. And if you can't find one you like, come with my guys.
Yeah.
It's the same with the conveyancing. Do your own homework, do your own research, find a conveyancer that you like and trust. If you can't, I've got you covered, right? I've got someone that I have spent quite a lot of time choosing really carefully because I want them to be genuinely better than people expect in terms of service levels. I now have conveyancers I'm working with set up, ready to go. I haven't actually got the webpage set up yet. Just message me privately somewhere if you want their details on Instagram or on Twitter or wherever, and I'll put you in touch with them. But the webpage should be up within a week or so, which means that I can now set any movers up with mortgage, conveyancing, and search packs, so you can get them on the day that you're offering, to massively speed up your transaction, improve your chance of your offer being accepted, and improve the chance of the deal going through and not falling through, because it'll be sped up. But all of those three things are here as a backup. Okay, go out and find your own, someone that you trust and that you're happy with the choice. If once you've done your research, no one stands out to you as the person you want to go with, then my guys are here to back you up. I hope it's helpful. I hope that message is helpful. Like, choose for yourself, but if you're struggling, I've got you covered. All right. And I'm very excited because, as we, what everyone in the moving industry, and I think, Lewis, you'd agree with this, everyone in the moving industry agrees, is that upfront information on both the buyers and the sellers side is the easy, no-brainer way to get your transaction through.
Got massively.
It's just a no-brainer, and everyone in the industry is just mashing their face against a brick wall, going, "Why don't movers understand that if you want to get your transaction through, get your information, your ducks lined up in a row up front? It's all you have to do. You're going to have to do it anyway. It doesn't save you anything by putting it off. It just increases the chances of a fall through." So I'm going to be making sure that all of these products are available through Best Agent as well. On the Best Agent website, so that if you want, in one place, you've got your mortgage, your conveyancing, and your search packs lined up, ready to go, and massively improve the chances of your deal going through. So I'm excited about that, because we may genuinely end up with Best Agent being a place that not only you can find an agent and a property, but also get your ducks in a row in one easy place, lined up, ready to go. On that happy note, guys, I want to thank you all. I want to thank Lewis and thank Alex for joining. It's been really fun. That time has just shot past, an hour and 10 minutes. I hope you've enjoyed it. Thanks for coming. Thanks for your time. And more videos coming soon. More people, more guests on the channel. Lots to do. Lots to talk about. Follow me on Twitter if you don't. moving_Charlie, which is where I keep everything up to date on a daily basis.
Mortgage Yoda, I like that one. Mortgage Yoda.
Oh, is that a comment someone said?
Yeah.
Mortgage Yoda, yeah, brilliant. Thanks, guys. Got to say good night. So see you on the next one. Have a good one. Bye-bye, guys.
Good night.